Are you worried about capital gains taxes? If so, there are strategies that you can implement today to reduce or even eliminate those taxes altogether. Now, in this video, we'll discuss what capital gains taxes are, the difference between those types of capital gains, and strategies that you can use to avoid or minimize them. Before we get started, let's define what capital gains taxes are. Now, capital gains taxes are the taxes on the profits you make from investments. Now, the good news is that there are strategies that you can use to eliminate or minimize those taxes. So, I know what you're thinking. What are the different types of capital gains? Let's start with short-term capital gains. Now, short-term capital gains are when you've held a stock or an investment for 1 year or less. And these taxes are taxed at the same rate as your ordinary income, your W 2, and are usually higher than long term capital gains tax rates. On the other hand, long term capital gains, those being held for a year or more, are preferential treatment in the federal tax code. And these are taxed at a much lower rate than ordinary income tax rates, with a max of 20%, but can be as low as 0%. Now, you can use numerous strategies to reduce or avoid these capital gains taxes on the stocks you sold for a profit. Now, each has its own unique pros and cons that you should look at to see if it's a good fit for you and your situation before moving forward. Now, let's look at some of the most common methods you can use to integrate into your financial plan. Now, first up, investing for the long term can help you benefit from those long term capital gains tax rates, which remember can be substantially lower than your ordinary tax rates. And in 2022, the long term capital gains rate was 0% for those who had a taxable income of less than $41,675 for a single filer, or if you were married filing jointly, $83,350. And in 2023, those numbers get bumped up to 44,625 and 89,250 respectively. Second, when selling your stocks, it's possible to pick your cost basis on the shares that you sell. Now, you may be able to avoid capital gains taxes by selling hand-picked shares that are at a loss or at least a lower gain, even if your overall position in that investment made money. While the state you live in won't affect your federal taxes owed, moving into a more tax-friendly state may help you avoid capital gains taxes on the stocks when paying your state income taxes. Now, at the time of this video, there are 9 states that don't even charge a capital gains taxes. Alaska, Florida, New Hampshire, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming are those 9 states. Now, lastly, at least for the purposes of this video, there's the Tax Cuts and Jobs Act of 2017. Now, this created what is called opportunity zones, and these offer tax advantages to investors. And by investing in these low income and distressed communities, you can defer your taxes and avoid capital gains taxes altogether. Now, to qualify, you must invest your unrealized gains within 180 days of a stock sale into an eligible opportunity fund. Then hold the investment for at least 10 years. Now, this program ends in 2026. So if you want to take advantage of this opportunity, you're running low on time. Now, capital gains taxes can negatively impact your investment profits, primarily if you hold an investment for 1 year or less. But luckily, there are numerous strategies that you can use to avoid or reduce these capital gains taxes on your stocks, real estate, or other assets. Before making any decision, though, talk with a financial planner or tax advisor to discuss your current situation and the strategies that you are considering. Thanks for watching this video. If you found any of this helpful, please give this video a thumbs up. Remember to subscribe for more videos just like this. Now, if you have any questions or suggestions for any further videos in the future, please drop them in the comment sections below. We'll see you on the next video.